So the basic principle of the scientific beta climate impact consistent indices is to weight stocks based on their climate performance relative to their sector peers. And by climate performance, we mean both their negative impacts. We want to reduce the negative impact, and specifically reduce their greenhouse gas emissions, their carbon emissions. And we also want to increase the positive impacts, and this can be measured in particular through the green revenues. So revenues coming from activities that have a significant positive impact on climate change mitigation or climate change adaptation. And as from the June 2022 methodology update, we will use the EU taxonomy as the reference for the green revenues definition. So in this presentation, we are going to give an introduction to what this EU taxonomy regulation is about and how it works. And then we will go into more details into how we believe that EU taxonomy considerations should be taken into account in portfolio construction in general, but also more specifically into the climate impact consistent indices. So first section is about the EU taxonomy regulation, how it works and what it is about. So the purpose of the EU taxonomy regulation is to increase investments in sustainable activities. And the EU saw as one of the main obstacles to investment in sustainable activities the lack of standardized definitions and reporting around sustainable activities. What does it really mean to be green? And there was a big risk and big problems around greenwashing, both from corporates, so companies claiming to be green in their activities, and then greenwashing also from investors when they invest in these activities and claim that these activities are green. So that's why the EU sat down and started working on this EU taxonomy regulation, which was then adopted in 2020, in order to standardize the definitions of what green activities is and to impose disclosure requirements, both on companies, on corporates. So larger corporates need to now report both the revenues, but also the operating expenses and the capital expenditures into these green activities. And then financial market participants, and in particular, basically all different investment products, including UCITS funds that are marketed in the EU, will need to report on how much their portfolios are exposed to companies having these type of activities. And in the future, it could even have an even broader impact on sustainable investment, because it could be taken into account into budgetary and monetary policies and also into solvency requirements. So it's basically a very important regulation from an EU perspective when it comes to fostering sustainable investments by improving the standardization and also therefore the confidence in the quality of sustainable disclosures. And it must be said that the EU has often been criticized for coming up with nitty-gritty rules, extremely technical and detailed technical requirements that were unnecessary. For example, the most common example would be, let's say, the alleged regulation that you should have straight cucumbers, for example. But in this case, I believe that there is a large consensus around the quality of work performed by the EU. They have indeed come up with an extremely detailed regulation. There are an extreme level of granularity in the definition of green activities. They've worked a lot on the different thresholds, the technical requirements to define even more precisely the positive impact of these different activities. But this level of detail should be seen as one of the main benefits, one of the main qualities of this regulation, instead of just as the usual criticism of the EU bureaucracy is. And as you may know, Scientific Beta has been in the past critical of some EU regulations, in particular pertaining to the Paris-aligned benchmark regulation and some of the technical aspects of that regulation. But we are clearly very happy with the way that the EU taxonomy work has progressed and has come up in the end. So this is at the European level, but also more globally, let's say, a reference in terms of regulating definitions around sustainable activities and disclosures. Now, what is a sustainable activity according to the EU taxonomy regulation? First of all, the activity needs to have a substantial positive contribution to one or more, or at least one of the 6 environmental objectives of the EU. And these 6 environmental objectives are, first of all, climate change mitigation, and second of all, climate change adaptation. There are also 4 other objectives linked to water and marine resources, so protecting biodiversity in maritime environments in particular, avoiding waste and promoting waste recycling, pollution prevention and control, so basically avoiding pollution accidents in particular, and protecting biodiversity more generally. But as a starting point, the regulation of the EU taxonomy pertains to the first 2 objectives, climate change mitigation and climate change adaptation. That's why some may believe that the whole taxonomy is only about climate change, but in the future it will also encompass other environmental objectives. But as a starting point, it does indeed pertain to climate change. Now, so first of all, the first criterion, you need to have a significant positive impact to at least climate change mitigation or climate change adaptation. But you also need to have no significant harm to any of the other objectives. So very positive on at least one objective, not very negative on any of the other. That's the basic principles. In addition, you should have, there are some minimum safeguards pertaining to ESG, fundamental ESG principles more broadly, beyond the environmental concerns. And in particular, these are defined with reference to the UN guiding principles on business and human rights, which relate to, as the name says, to human rights, but also to fundamental labor rights. And the other reference point is the OECD guidelines for multinational enterprises, which is substantially broader than just human rights and labor rights, since it also encompasses issues such as corruption and bribery, and taxation, and also anti-competitive behavior. So it's the OECD guidelines are, as you may know, quite broad in terms of scope of different ESG principles that should be taken into account. So just to summarize again, very positive on at least one environmental objective, not very negative on any of the other environmental objectives, and you should respect some fundamental ESG principles with reference in particular to the OECD guidelines. And there are some technical screening criteria. So how does the regulation define substantial positive contribution or significant harm? There are, for each type of eligible activity, different technical screening criteria which are set out. And for some of these criteria, the actual thresholds and criteria will evolve over time. So, for example, when the criteria are set as kind of a best-in-class or state-of-the-art at the current technological availability, this will of course evolve over time and will become more stringent as the technology improves over time. So there are technical screening criteria for the different eligible activities. Now, those were, let's say, the definition of what it means, and you can divide these eligible activities into 3 different types. So first of all, you have the green or adapted activities. And green or adapted activities are activities which are intrinsically, in an absolute sense, have a very strongly positive impact on climate change adaptation when it comes to the adapted activities, and a very positive impact on climate change mitigation when it comes to the green activities. So let's say they are green or adapted or have a very strong positive impact in an absolute sense, intrinsically. The second category are called transitional activities. These are basically not low carbon, or in an absolute sense, they may actually have quite high carbon emissions, but they are at this point in time state-of-the-art, best-in-class in terms of their industry, in terms of their carbon intensity. So they are, let's say, relatively low carbon relative to the other technological alternatives out there, and there are no other better substitutes at this point in time. So these are the transitional activities. The third category, the last one, is called enabling activities, because they are not, let's say, absolutely or relatively the low emitting or positive contribution activities in themselves, but they enable other activities to be so. So these are, let's say, enabling in more often indirect impact on climate change mitigation or adaptation. So green or adapted, absolutely positive impact. Transitional, relatively positive impact in a direct sense, and enabling activities with a positive impact more indirectly as they enable other activities to become green or in low carbon. Now, so it's a very granular approach. You can see the numbers here. Currently, there are 88 climate change mitigation eligible activities and 95 different eligible adaptation activities. So it's a very granular approach, which can then be matched to different granular sector classification systems, like the NAC in Europe in particular, that enables, let's say, a link to the traditional sector classifications in particular. So that's what the three types of eligible activities in the EU taxonomy was about. Now I'm coming into the second part, where I'm talking about how we believe that these data sets, so revenues as a starting point relating to these activities, should be taken into account into portfolio construction. And therefore, of course, when we recommend something, we also translate that into the portfolio construction of our own climate impact consistent indices. Now, the climate impact consistent indices, as I mentioned, the basic principle is that we weight stocks depending directly based on their climate performance. So it's climate performance is not a mix of climate performance and other financial characteristics, in particular the market cap of companies. So we weight stocks based on climate performance relative to sector peers. That's the most important thing you should remember about the methodology of the CIC indices. And this is basically the second step in the portfolio construction methodology, which you see here. The table recaptures all the 5 different steps, but the main one is the second one, weight stocks based on the climate performance relative to sector peers. And by climate performance, as I mentioned, we do take into account the negative impact captured by the scope 1 and 2 divided by revenues, carbon intensity of companies. And we also make some adjustments for the positive impact, so the green revenues, which we are here to talk about today, but we also make some adjustments in particular for the forward-looking perspective, where we take into account the decarbonization commitments of companies, and there we use the Science-Based Target Initiative data. Now, it must be said that it's important to have in mind that there are basically different ways that companies can have an impact. We talk here about impact, not in terms of small cap, single purpose companies. We talk about impact in public listed equities, large and mid cap companies. And therefore we define basically impact as the ability of the investor to influence the behavior of these large corporations over time. And this influence can come through capital allocation decisions. So basically, investors can decide to increase their allocation of capital to companies that make a climate effort, and thereby reducing their cost of capital, thereby basically favoring the growth of these companies. And vice versa, they can withdraw capital from laggards in terms of climate performance, increasing their cost of capital and thereby hindering the development of these companies. So investment decisions can have an impact on the activities of these companies through capital allocation or investment decisions. There can also, of course, be an impact through engagement with these companies, exercising your shareholder rights, and also having a dialogue with companies, trying to influence the behavior of company managers. And of course, there is a link between the two, because in order to have effective engagement, it's much better when these engagements, these dialogues are backed up by clear and consistent investment decisions, whereby it's clear that the companies know that they will be rewarded if they may basically live up to the expectations that the shareholders put forth to them during the dialogue, and they should know that they will be penalized if they don't live up to the expectations of the different engagement campaigns. So when it comes to these, what we call impact channels, it's clear that there will be more impact if there is more convergence among investors. So basically, if 100 different investors use 100 different metrics and 100 different data inputs, there will first of all be less impact on cost of capital, simply because basically there will be less impact on the supply and demand of the particular stocks, because investors will not agree on which stock is good or bad on a single issue. They will have 100 different issues to deal with, and they will have make very different and divergent investment decisions. And when it comes to engagement, when you sit down and have a dialogue with investors, again, there will be much less impact if each different investors come to the CEO and say 100 different things. Whereas if they all agree on a common goal and use common metrics to judge whether the company has achieved these goals, there will be more effective dialogue, and there will probably be much more incentive for the company managers to act. So convergence on reliable data and metrics increases impact. This is the title of this slide. And therefore, in particular, Scientific Beta has spoken out in the past against using divergent and non-reliable data sets. And over time, there have been different ways of judging the climate performance or the environmental performance more generally of companies. There have been this green revenues, so basically investment in activities with positive or negative contributions to climate goals. So this is what we're talking about today. So this is one way to judge the climate performance of companies. You have what people call comparative emissions, where you basically look at, or this is also called often avoided emissions, because basically the goal would then be to say, okay, how much emissions have I avoided since I use my technology instead of let's say the sector average or the technology of the competitors of the company. And therefore, companies often claim that they have avoided emissions or have negative emissions because their technology is less carbon intensive than that of their competitors. But this is fraught with estimation problems in particular. And more generally, you have environmental scores or environmental ratings. This is probably the type of environmental metric with the longest history. Environmental scores have been around for more than 2 decades. There is a large number of different providers of these different ESG scores and environmental scores, more particularly. And then more recently, there have been what is called the implied temperature rise scores. So basically trying to translate the future decarbonization targets and or trajectories of companies into an implied temperature score. So basically, if all companies were to follow that kind of trajectory in that industry, what would the expected temperature rise be? So basically, this gives a more intuitive number to compare companies with, compared to, for example, a score of 100, which is less telling than an implied temperature score. But again, even though there are many benefits of the implied temperature rise scores or temperature scores, said more simply, there again are a lot of estimation problems, which make them a bit problematic to use as an input in portfolio construction at this point in time, though in the future this may be a more interesting avenue for developments, and if different providers manage to reduce the divergence among them. But we as a company, Scientific Beta, we have spoken out against unreliable data, and by unreliable we mean that basically the numbers that the provider come up with do not necessarily reflect what they intend to show. And a good way of judging the reliability of something is to look at the divergence across providers. If you ask the questions to 2, 3, 4, 5 different providers and then come up with widely differing answers, it's probably because the data is extremely unreliable. And this is the case in particular with these environmental scores. There have been numerous academic papers on this issue. There's also an ongoing research project going on at the MIT trying to reduce this divergence among environmental scores. But keep in mind that there's only about a 0.5 correlation between the scores of different providers. So this is a very low correlation compared to, for example, scope 1 and 2 carbon emissions, which we use as the main input to judge the negative impact of companies. So most companies report, and most companies in the large listed equity universe self-report their scope 1 and 2 emissions, and these can be quite reliably produced by the companies themselves. But even when providers estimate scope 1 and 2 emissions, the correlation between different providers has been shown to be about 0.85, so much closer to 1 than the 0.5 correlation that I mentioned for ESG scores. And that's why we in particular spoke out against one of the proposals of the European Union to make the reporting of ESG scores, average ESG scores of a portfolio compared to a benchmark, mandatory in particular for the climate benchmarks of the EU, so the regulated CTB and PAB indices. It was proposed at the point in time to make it mandatory to report average ESG scores for these indices. We spoke out against that, and fortunately the EU retracted that proposal and it was not made compulsory. But we have a long history basically in promoting the use of reliable data for the purpose of constructing portfolios and speaking out against unreliable data. And we also, when it comes to climate impact, beyond this question of reliability, we clearly believe that it's better to use publicly available and standardized data sets. So by standardized them and publicly available, one option is regulated definitions and mandatory disclosures or by companies, such as the case for the EU Taxonomy regulation. But we also use, for example, as I mentioned earlier, the Science-Based Target Initiative. There are also other data sets and other frameworks out there that try to basically create more convergence among investors, for example, through investor coalitions and initiatives such as the Paris Aligned Investment Initiative that try to create more convergence among different investors on which data sets and which metrics to focus on. This increases the impact, as I mentioned earlier. So use reliable data and preferably use publicly available data, or at least the data that investors in general have decided to agree to converge upon. So that was, let's say, the principle around that. And so what we do is, as I said, we weight stocks based on their climate performance relative to the sector peers. And there we use scope 1 and 2 emissions divided by revenues as the carbon intensity metric, basically to measure the negative impact. So since I said scope 1 and 2, it means that we don't take into account scope 3 emissions directly when comparing companies to each other in the same sector. And the reason is that basically there are two ways of procuring scope 3 data. Either you can use self-reported scope 3 emissions, and while it's not very common today to report for companies to report scope 3 emissions, it's not let's say mandatory from a regulatory perspective. This is changing slowly. Let's say the TCFD is making recommendations to report more scope 3 emissions. If you want to have SBTI approved commitments, you will most likely need scope 3 emissions to be included in the target. So you need at least to compute your scope 3 emissions. And as some of you may have seen in the US, the SEC has come up with some proposals to make the disclosure of scope 3 emissions mandatory for larger corporations in the US. So basically, we can expect in the future the self-reporting of scope 3 emissions more common. However, it needs to be said that the companies, even when they comply with the greenhouse gas protocol to compute and report their scope 3 emissions, they still have a lot of flexibility in the way they compute them. And this is because scope 3 emissions in the protocol, the idea was to have something that from which you could track the progress of one company over time, from one year to the other, even though there's a lot of flexibility. If it's, once they have selected the methodology for scope 3 computation, you could follow that over time and measure progress. That's what scope 3 reporting was intended to achieve. It was not intended to achieve comparability of two companies in the same sector at one point in time. So therefore, even though we will have more and more scope 3 reported data, it will not mean that you can directly use that data to compare companies at one point in time in the same sector. Now, the other alternative, instead of using self-reported scope 3 emissions data, could have been to use estimated scope 3 emissions data to compare companies in the same sector at one point in time. However, if you use, for example, some kind of sector model whereby you estimate the scope 3 emissions depending on the activity of the company and some measure of its size, for example, let's say revenues, number of employees, or whatever, it means basically that you assign the scope 3 emissions of the average of the sector, in a sense, to the company. And that means that you don't take into account the specific efforts of the company's managers when you evaluate them. And we all know that if you want to incentivize somebody to do something, if you want to reward somebody for their effort or punish them for their lack of efforts, you need to focus on their specific contribution. If you just say, I will assign you the same average grade as your class, there is no real incentive for them to do any better than the other pupils in the class. So this is basically if you use estimated data based on some kind of sector model to assess the climate efforts of company manager, you defeat the whole purpose if your purpose is to incentivize climate change efforts and therefore to combat climate change. So that is why when we compare companies, we still use scope 1 and 2 emissions. But as I said, we do make some adjustments. One adjustment is the forward-looking perspective using the SBTI, which includes scope 3 data. And also, and this is what we're here to talk about today, the green revenues adjustment. Because one reason for making this green revenues adjustment is that, in particular, when it comes to enabling activities, they basically reflect their good proxy for the scope 3 emissions linked to the use of the product of a company. So they're useful, in many circumstances, a useful scope 3 proxy for a lot of companies, and a much more reliable proxy than, for example, sector-based scope 3 emissions estimates. So that's one reason to use the green revenue adjustments, is to better reflect the indirect emissions, the scope 3 emissions of companies, which is not directly reflected by the scope 1 and 2 divided by revenues carbon intensity that we use as a starting point. The second reason for making the green revenues adjustment is that we don't just want to measure, let's say, the negative contribution of companies, but also their positive contribution, or what is called the climate solutions in the Paris-Aligned Investment Initiative framework. So also focus on the, let's say, the positive aspects, and also the, let's say, the business opportunities, the investment opportunities, and not only, let's say, what could be called the investment risks of linked to climate change. Now, how do we actually in practice make this adjustment? So we take the carbon intensity and we adjust it downwards if they have more green revenues, but we give there is a hierarchy between the three different types of taxonomy eligible activities that I mentioned earlier. The green, what is called the green activities are, which are the absolute low carbon activities or even negative carbon activities, should receive a higher reward than the relatively positive activities that we call the transition, that are called the transition activities. So green should be better than transition, and best of all, we give a higher reward for the enabling activities, simply because since we have taken into account the scope 1 and 2 emissions already, we want to give higher adjustments for emissions that have not been taken into account by scope 1 and 2 emissions. And this is mostly the case for enabling activities, since they basically are activities that enable other activities to have a positive impact. So they are basically reflecting more scope 3 emissions. So that's why we give more, even higher adjustments for enabling activities compared to green, which is itself higher adjustments than transition activities, which are only, let's say, relatively green at this point in time, given the technological alternatives. So in practice, what are the numbers? We take the percent of revenues which are aligned, so which probably at this point in time, there's let's say more of an assessment of whether the activities of companies are aligned with the regulation, because basically companies will start reporting their alignment only next year. So for the time being, basically it's more of a probabilistic approach to this. And what we do is, so we have, let's say, the probably or potentially aligned revenues of each company, and then we divide that by an adjustment factor. And the higher the adjustment factor, the more we reduce the current carbon intensity of companies. And the adjustment factor is then 60% for enabling activities, 30% for green activities, and 15% for transitional activities. And we still also do take into account other enabling or green activities beyond those which are recognized by the EU taxonomy, but only if these activities are on top of the revenues that are aligned with the regulation. Now, in conclusion, there are a number of key benefits of this regulation. As I said, we are very happy with the way that the work of this regulation has progressed. In particular, the fact that there is a regulated, standardized definition of green activities enhances the impact potential. So as I said, the more investors converge on the same metric, the bigger the impact on capital allocation decisions and therefore on corporate behavior will be. And it also gives a common language to speak during dialogues between shareholders and companies. So this increases the impact of the sustainable investment activity and engagement activity if to have this kind of taxonomy regulation. It also, secondly, enhances the portfolio alignments. So the portfolios that use this kind of this data are more aligned, in particular, on the recommendations of the net zero investment framework of the Paris Aligned Investment Initiative. Because when the Paris Aligned Investment Initiative basically uses the EU taxonomy as a reference for its climate solutions. So this, let's say, the second pillar of that framework, which is to enhance investments in climate solutions, the main reference there for defining climate solutions is the EU taxonomy. So it gives basically the EU taxonomy a global reach than just a regional reach within the EU. It is clearly a global reference, and also a reference for other similar regulations to come. The first one in particular being the UK taxonomy, which is likely to be very similar to the EU one. So it's, let's say, a global and international reference point in this area. It does, as a third point, increase the exposure to climate-related opportunities when you use this EU taxonomy. So, as I said, instead of just looking at the negative side of climate impact, the climate risk side of thing, looking at the other side of the coin, which is climate-related opportunities, is facilitated through the use of the EU taxonomy regulation. And this is, fourthly, because basically by having a regulated definition and a high quality and very granular work that has been performed by the EU, this promotes confidence in the data reported, first of all, by the companies themselves, and second of all, the reporting done by investors who then invest and finance these corporations. So there's a number of benefits of using the EU taxonomy regulation, and it is not purely a regional initiative. It will have a more global reach as well.